Well, I wanted to take one of your questions that somebody had in terms of how they should best invest their money. And one of the questions was, well, I have, let's say I have $300,000, I have them sitting in, or $250,000, however much, in a savings account. It's pretty safe there, it's FDIC insured, there's nothing going to happen to it, it's going to be sitting there, it's making its 4.15% interest rate, which is an average interest rate that we picked from the internet for savings accounts. Inflation has been overall on average 2.5%. So how could I better invest this money to have a higher rate of return using real estate investment strategies? So in order to compare apples to apples, the very first thing that we did is we took that $300,000 that's sitting in savings and kind of calculated how much at the end of a fifth year, having it sit there for 5 years, how much money we would actually make off that investment. Now we took into account some of the compounding tables that are available online, money that is made on money that's made in the future, so it compounds over time. So this $300K that's sitting in a savings account with this interest rate, this inflation, subtract one from the other, makes about $15,000 at the end of year 5. So let's see if we can beat this using very simple investment strategies, real estate investment strategies, and see if we can beat that number. So what I did is I took from those $300,000 only half, $150,000, and see if I could gainfully use that in order to invest in real estate and make some more money. So I took $150,000. I found 5 properties that were worth about $100K each, and kind of decided to put 20% down. That's a really good number for an investment property, and counted about $10,000 extra for each property as extra expenses that you would need to close on a property, to kind of do small little fixes to make it ready for rental, for example, putting a new coat of paint on, or fixing little things that inspectors find. Or sometimes the banks require you to, they do an inspection, and depending on their underwriter, require you to fix this or that, or things like that. Sometimes the seller pays for this, sometimes the buyer pays for this, but in this case we want to be very generous and make sure we account for this. So I counted $30,000 invested in each one of the 5 properties that are each worth about $100,000 each. $100,000 each. So there's 5 here, 3,000. So what I'm invested right now is $150,000. That's about half of what we have in the savings account sitting over there. So reasonably, your rental income for those 5 properties over 5 years is what I've calculated, about $55,000. That's counting that out of 12 months, each property is rented about 11. 1 month you're not getting any rent because maybe your tenants are moving out and there's a vacancy for about a month or so. So you would calculate basically $1,000 per month per property times 11 months times 5 properties, comes out to be about $55,000. That's your income that you expect to get in 1 year on those 5 properties. Now the next is your expenses. I kind of calculated the expenses in summary as follows. Your management fees are about 10% of your rental income. Being that our rental income up here is $55K, your management fees are about $5.5K. That's of course assuming that the rent is $1K a month per house, and the management fees are 10%. Sometimes they're 8%, sometimes you can negotiate that, sometimes you can even manage the properties yourself, and then you don't have that expense. But let's just assume that's the numbers, so $5,500 for expenses for management fees. Maintenance and repair, I went a little bit generous on this. I went with $10,000 per year for all 5 properties. That's about $2,000 per property per year. Kind of counted that because of various things that may be going wrong, and various maintenance expenses that are recurring, such as pest control, such as putting some money aside for maybe a new roof later on, or other things. But $2,000 per property per year is a very generous number. it's a good number to use. That's the kind of number that I typically see on my properties. The next big expense that you have is your mortgage payment. Your mortgage payment, depending on your interest rate and definitely your tax rates and things like that for your locale, calculated it to be about $750 a month per property. So $750 per month per property is for 5 properties for 12 months, because you have to pay your mortgage all 12 months even if there's a vacancy. It calculates to $45,000 per year for all those 5 properties. Now, a mortgage payment usually includes an escrow or an impound account. This is the account that you have to pay into that later then pays your taxes and insurance. It's a requirement by most mortgage companies, so this $750 includes that amount. So $750 includes your taxes, your insurance, as well as your principal, down payment, and your interest. So everything is included in that. So far for all of our expenses, for all those 5 investment properties altogether, if you calculate all of this together, is $45,000 plus $10,000, that's $55,000, plus $5,500, that's $59,500. And then since you have this income here sitting, the $55,000, the difference is about $5,500. This is a negative number because I calculated that with these numbers here that your expenses for that first year are going to be more than what you're actually collecting in rental income. Now this could change depending on how your vacancy rates are and how much rent you're collecting. So you could very well just break even or even make a little. So in this example, however, this is your $5,500 that you spend out of pocket. It's a cash expense, money out of your pocket. This is what you have to put out in addition to the $150,000 that you invested up here in down payments and closing costs for the 5 properties. Now, that is an actual tangible expense. Now we're talking about some more expenses here. For example, you have the interest expense. Most of your mortgage payment, the $750 a month right here, is going to go towards interest expense, especially at the beginning of a loan. So what I calculated for the 5 properties is approximately $35,000 for that entire year. That is an interest expense off this mortgage payment that you're making every month. You also want to think about the depreciation expense. Every real estate property in the United States is depreciated usually over 27.5 years, which means a $100,000 property, the $100,000 is at the time of purchase, give and take. You have some various calculations that go into that, but you divide it by 27.5, and that is the amount that you can use as a depreciation expense per year for the next 27.5 years until it's fully depreciated. So that's another expense that you may be qualified for, depending on what kind of interest rate or what kind of income level you are. You have to talk to your tax accountant about that. So in addition to the $150,000 that you put out in buying the properties and putting the down payments down and paying the closing costs, the $5,500 in additional cash expense because you had more expenses than rental income that year, you also have this interest and depreciation expense. Now if you add your interest expense, your depreciation expense, and your cash expense, your total expense is $53,000 for that year, which means that that is an actual, partially or most of it is a paper loss. You don't have to put out $53,000 per year, even though you did pay the interest and the depreciation is an actual expense. Most of that money came from this rental income that you've been collecting. So out-of-pocket expense, very little. Paper expense, very big. What that translates to is that if you go to file your taxes, you can now deduct your taxable income by that whole entire $53,000, and if you're in a very high tax bracket, such as maybe 33%, that translates to you in direct tax savings of $19.3K, $19,300 in tax savings. Now, we're not done yet, because that's just one of the parts of the great thing of investing in real estate. In that same exact year, because you had 5 properties, you actually increased your equity. You basically paid down your loan. It wasn't very much the first year. In future years it might be a lot more, but in this first year you have $9,000 of equity made in those 5 properties. So if you add that to your tax savings of $19.3K, you have $28.3K of savings in that year. That's just 1 year, at the end of year 1. And what you've used is $150K investment and your $5,500 extra expense here, that because your expenses were higher than your income. So all in all, you invested approximately $155,000, and you made $28,300 just in that first year. Now, I'm not even looking at one other way or place where you actually made money, and that just depends on your locale or where you're located, where your real estate is. But you can actually make money also by your property appreciating in that year. A lot of calculations for real estate investments include that. I haven't included that here, but if you feel comfortable, you can add $1,000 per property per year in appreciation. That just means that at the end of the year, your property is worth more than it was worth at the beginning of the year. So you could possibly add even a couple more $1,000 to this number. So, and we're not even talking now about compounding this or reinvesting money that we've made, but if we take this $28,300 and just simply multiply it times 5 over the 5 years that we're comparing this other column to, we're making $141,000 some dollars over 5 years using this investment strategy with real estate, while as in this scenario where we left it in savings, we only made $15,000. So if you need more information on some of these calculations or how I arrived at this, or if you have any questions, go to my website at juliamspencer.com, and you can also download a free guide to real estate investing.